Good afternoon, everyone. This is Pat Somerville, Senior Partner and Co-President here at Hamilton ETFs. I want to welcome everyone to our webcast today. I'm joined by my colleague, our co-founder and Executive Chairman, Rob Wessel. We have a fantastic session lined up today where Rob's going to talk about the Canadian banks and specifically talk about why we think this is the toughest stock picking environment for the sector in 30 plus years. So in terms of the agenda, the webcast is going to run about an hour in length. I'm going to provide a very quick update on Hamilton ETFs, introduce everyone to a couple of new investment ideas that we're quite excited about. And then I'm going to pass things off to Rob, who's going to take you through various topics on the Canadian banks, and we'll wrap up in about an hour. I'll remind everyone this is eligible for CE credits, so we will be sending those CE credits in the coming weeks. So just a very quick update on our firm. We have a very big audience today listening in, and I just wanted to take a moment on behalf of everyone here at Hamilton ETFs to thank everyone for their ongoing support. We continue to be one of the fastest growing ETF managers in Canada. I know a lot of ETF providers say that. I just want to give you a bit of context. In the past 5 years, our assets under management have grown from 250 million in AUM to over 7 billion today. So we're ecstatic about that growth, and we're also incredibly grateful to everyone who's been following us over the years. Our firm has evolved over time. We remain one of the leaders in financials ETFs and one of the largest providers of Canadian bank and financials ETFs, providing various ETF options for exposure to the Canadian banks, the Canadian financials, but also some global ETFs to give investors some diversification. We were one of the first, and we were the first, and we are the largest provider of enhanced ETFs, which provide exposure to sectors like the Canadian banks, Canadian utilities, with modest leverage at 25% to enhance the long-term growth potential and yield of the sector. So I'd encourage everyone to look at those. And then about 4 years ago, we entered the covered call market. And quickly, we have become one of the largest and the fastest growing covered call providers. We have a very popular suite of yield maximizer ETFs, which offer an income first and tax efficient covered call strategies and provide options in virtually every North American sector. So an option for investors to, if they're income seekers, if they're seeking tax efficient income, a host of options in that suite, and they have become very, very popular in a short period of time. And then that brings us to our next chapter. We have recently launched what we call the Hamilton Champions suite of ETFs. I'll get to that in a minute, but effectively what we have we are now entering into the low cost core equity, US core and Canadian core equity at a low cost. So I'm going to take everyone through those in a couple of slides, and then we will hand things over to Rob. So here we have what we call our Hamilton Champions ETFs, which provide exposure to blue chip companies with a long history of growing dividends. They're built for long-term growth. On the left, we have what we call the MVPs, ticker CMVP and SMVP. That's the Hamilton Champions Canadian Dividend Index ETF and the Hamilton Champions US Dividend Index ETF. Both have a 0% management fee that will be run through until January 2026. After which it will reset to 19 basis points. So very attractive cost even after the fee holiday. And then on the right, what we have are we call the winners. They trade on the ticker CWIN and SWIN. Effectively, what these are modestly levered versions of CMVP and SMVP, providing a bit more enhanced growth profile for long-term investors and a little bit of enhancement to the yield. We're very excited about these. We think these can form a core part of investors' equity portfolios, and we're quite excited to bring these to market. So all of these ETFs, they've tracked what is called the Selective Canadian Dividend Elite Champions Index, as well as the US Dividend Elite Champions Index offered by Selective. Here on this chart, you will see this is the Canadian version in the blue line. You will see the index going all the way back to 2006, so about 19 years, and impressively has outperformed the TSX 60 by just about 200 basis points compounded over that period of time. And then the gold line shows you what the index would have done if you had employed modest leverage at 25%. So that would lead you to a bit of a backtest to show you for CWIN, for example. So not only has the performance of these indices been impressive, you'll see here the volatility is actually worth noting as well. So on the Canadian version, we have long-term outperformance versus the TSX 60, but we also have lower volatility, lower drawdowns, faster time to recovery. So all this information is on our website, which you can view. And we also have a slightly higher yield as well than you get from the TSX 60. And then here you'll see the selective US Dividend Elite Champions Index, effectively the exact same return as the S&P 500 going back to 2006. You'll notice that over a long period of time, it actually had outperformance. It's really only been until recently with a massive tech rally that we've seen over the last year or so, where the lines have been a bit more converged. But needless to say, very good performance over the long period of time. And then again, the gold bar shows you the impact of employing modest leverage of 25%. And then again on volatility, so here we have, like I said, similar performance, a slightly higher yield, significantly lower volatility, much lower drawdown, and a faster time to recovery. So again, this backs up our belief that these can be very good core holdings for investors in their equity allocations. And one thing I wanted to point out quickly, which relates to SWIN and SMVP, our US Dividend Champion ETFs, is that because we have exposure to companies that have long history of dividend growth, that leads the index to a pretty significant underweighting of technology. So we're not saying that technology is a bad place to be per se, but I think it is worth noting that in the S&P 500, for investors in putting money into an S&P 500 ETF, you do take on a fair amount of concentration risk. 32% of the S&P 500 is concentrated in technology, whereas our US Dividend Elite Champions Index ETF has about 6%. So I think it's a very good diversification tool for investors to consider as well as part of their equity allocations. So for more information on this suite of ETFs, I'd encourage everyone to come to our website. We did write what we call a dividend growth playbook. It takes you through the methodology and some of the returns and volatility metrics that I just took you through. And I'll remind you on CMVP and SMVP, these both have a 0% management fee until January 2026, and it will reset to 19 basis points after that time. And CWIN and SWIN are just modestly levered versions of those. They have a 0.65% management fee. And then finally, I just wanted to, you heard in my introductory remarks that we remain one of the largest providers. In fact, we're the second largest provider of financials ETFs. This slide just shows you our Canadian bank offerings. We like to think of ourselves as the home for Canadian bank investors. We offer two modestly levered solutions, HCAL, the Hamilton Enhanced Canadian Bank ETF. This is the top performing Canadian bank ETF. It provides equal weight exposure to the Canadian banks with modest 25% leverage, which again gives you an enhanced growth profile and a slightly higher yield. The yield is about 6% currently. And then for investors looking for a bit more diversification in their Canadian financials, we have HFIN, the Hamilton Enhanced Canadian Financials ETF. This is the top performing Canadian financials ETF in Canada since we launched it. Again, modest leverage, but a bit more diversification with the 12 largest financials in Canada. It's equally weighted, so you get diversification beyond the banks and into the life cos. And then finally, we have two low-cost options. In fact, they're free. We have HEB, the Hamilton Canadian Bank Equal Weight Index ETF. That is a $770 million ETF. Has a 0% management fee until January 31st, 2026. The current yield is 4%. And then for investors looking for more diversification, similar to HFIN, this is an unlevered version, exposure to the 12 largest Canadian financials, equal weight, also has a 0% fee for about 1 year. So we have enhanced options and very low cost options to consider for your Canadian bank allocations. And Rob will talk a little bit about why we think this is a good time to be considering equal weight exposure to the Canadian banks. Just very quickly on HCAL and HFIN, I just wanted to show you the benefits of utilizing modest leverage on the sector. So here you see 1.25 times our selective Canadian bank index going back to 2007. obviously significant outperformance, but I think the key thing to point out here on the slide is the volatility. So the volatility of HCAL since we launched it has been basically in line, or if not lower than some of each of the individual Canadian banks. So effectively, you're getting diversification, which is removing or mitigating some of the volatility that you take on by using modest leverage. So we think HCAL can be a very good replacement for individual Canadian bank stocks. Maybe it's an easy one just to tuck in to get diversification and a bit more growth in yield. And then very same story here on HFIN, but again, just more diversification across all the financials in Canada, the largest ones. And here again, you can see the volatility metrics of HFIN, very similar, if not lower than some of the largest Canadian financials that many of you would own yourself individually. So with that, I'm going to hand things off to Rob, and he's going to take you through some of the key issues facing Canadian investors or Canadian bank investors going forward and why this is the toughest stock picking environment in 30 plus years. Over to you, Rob.
Yeah, thanks. Thank you, Pat. And I want to thank everybody on the call for their time and attention. For those of you who have attended our previous webcasts, you may recall that typically we've generally had like 25 content slides, and I use a marker and I go through and I circle this on that chart and point to this and something else. Today I'm just going to talk because so I'm in my 31st year of specializing in the financial services sector. Spent time in investment banking, spent time in equity research, and obviously with this firm. And I don't know that there's been a more difficult period of time over that 31 plus years, if not longer, to decide how you want to assemble your portfolio for those of you who are active. So, ordinarily you would do a presentation like this, over the years, and I would come in and I would say, or I'd be on a webcast or whatever, and I'd say, here's what's going on with credit. Here's what's going on with capital markets. Here's what's going on with loan growth and margins, and therefore net interest income. Let's talk about reserves and capital. And oh, by the way, here's the relative valuations. And this bank is advantaged because of this variable, and this bank is advantaged over that variable. And, then we can talk about who might get multiple expansion and compression, and then who we like and don't like. That sort of generic template for a bank analyst or a bank investor is pretty much out the window right now. So we would point out that we think that this is, I would say, this is by far the most challenging period in which to compose your portfolio because, of course, it doesn't make sense if you are an active investor to own all six. You get the maximum diversification benefits from a three-bank portfolio. Typically, you get no diversification benefits by adding bank 4, 5, or 6. And the reason for that is the sector and its individual names are so correlated. So picking those three banks right now is extraordinarily difficult if you're an active investor. And we think there are two reasons that are making it so challenging right now in the current environment. The first challenge, if you will, is that 4 of the 6 Canadian banks have highly material and idiosyncratic issues overlaying their valuation, and the resolution of that particular issue and how it affects the bank and its earnings is very, very difficult to predict. So that's challenge number one. And challenge number two is there is very, very significant differences in the valuations. So let's talk about the first one, which is these idiosyncratic issues that are overshadowing the sector. So let's start with Bank of Montreal. So I'm gonna talk about how old I am, and I'm gonna talk about some of the history. But people who have owned Bank of Montreal, and I think its profile, if you will, would be one that has very, very low, relatively or comparatively low credit risk profile. So they they were the first to expand in the United States. I think it was 1991 they bought Harris, which was a pretty good platform based in what most people would call Chicago, but they used to refer to as Chicagoland. I think if there was a complaint over, say, the first 15 years of my career, it would be that, they had a pretty good platform in the United States, but it never seemed to drive as much incremental growth or outperformance as the market would have hoped, given the strength of the US economy. And then you fast forward into the global financial crisis, and Bank of Montreal, which up to this point, their US exposure was exclusively in Chicago, they made a very, very strategically advantageous acquisition And they bought a bank called Marshall and Isley. It was a very good deposit franchise. They ran into credit problems in the global financial crisis. Bank of Montreal was able to buy it at what was a very, very good price. Strategically, it fit perfectly. It moved their platform and expanded and added scale up into Wisconsin and Minnesota. So, up until recently, a pretty good US platform, maybe not the best region, but not the worst either. And, a pretty good platform. So then a couple years ago, they closed, or 2 years ago, actually, they bought Bank of the West. So for people like myself, I think, and I would imagine the bank analysts and bank investors probably were caught by surprise. Bank of the West was owned by a European bank. I think it's fair to say was not a terribly good platform, had single-digit ROEs. The platform was kind of everywhere and nowhere. If you go on our website, we wrote a note. At the time, we showed a branch map. And, Bank of the West had branch clusters in more or less San Francisco, San Jose. Then they had a branch cluster in Los Angeles and one in Denver. And then they were everywhere. I mean, with small platforms pretty much everywhere. So I'm not a geography major, but I'm pretty sure that Denver is nowhere near Chicago or Milwaukee. So it's a bit of a surprise that they would go so far afield and that they would buy a platform that was not really the highest quality platform and not really the best managed. So at the time, we wrote a comment which was something along the lines of this was a high risk, high return, potentially high return acquisition. The first was, why is it high risk? One is it's not contiguous or anywhere. Not only is it not in the same states, it's not even in the same region. Not a great bank, not great operating metrics, but higher return insofar as if you believe that Bank of Montreal's management team could fix the bank or get its ROE up, then there would be some meaningful room for value creation. At the same time, by virtue of the unique time period, which was post-COVID, where all of the banks had built up so much capital because they weren't allowed to buy back stock or raise dividends, they were able to finance what was the largest acquisition in Canadian bank history for almost entirely cash. So in effect, they really only needed to out-earn cash in order to get valuation accretions. And normally, bank merger 101 is when banks buy something, they typically take the biggest possible restructuring charge in order, and as well the biggest credit mark that they possibly can, and they almost engineer accretions. So out earning cash and hopefully with some conservative, restructuring charge and marks, then they would be able to build in, and there was no ROE dilution because they basically paid cash. So that would have been the idea. But it looks like what we see with the benefit of hindsight is that they caught the worst part of that, which is the high risk part. So I'm going to just give you I'm going to throw some numbers your way just to give you an idea as to what's going on. So Bank of Montreal was seen as the low credit risk bank, as I talked about or referenced, primarily related to credit culture, but also loan mix. So before Bank of the West, I think you would see BMO would probably have a normalized loan losses of, give or take 300 million a quarter, maybe 350. So they buy Bank of the West and the bank closes. And I'm just going to give you just an idea as to what's happened to loan losses since this deal closed. The first full quarter after, they booked 500 million. The next quarter, 450. Then they booked over 600 million, then over 700 million, then over, these are quarterly numbers, then over 900 million. And then in Q4, the most recent quarter, a whopping 1.5 billion. So the bank reported nearly 3.8 billion of loan losses last quarter. So I think it's fair to say that when they were pricing this acquisition, that they didn't put in anything close to 3.7 billion of provision. So here we are today. You're in fiscal 25. You've just finished Q1. Just finished Q1. And Bank of Montreal trades at 12.9 times 2025 and 10.9 times 2026, which is a 1.2 multiple point premium on current and a 0.3 multiple point premium on forward. So here you have a bank that made the largest acquisition in Canadian bank history that's not doing terribly well. I think you could say it's up to this point has been nowhere close to what they would have hoped, trading at a premium. So this idiosyncratic issue related to Bank of Montreal and is that I don't think the market has a sensible or reasonable idea as to what is normalized loan losses for Bank of the West. We don't know if the underlying credit risk profile of Bank of the West of BMO has been fundamentally altered because of Bank of the West. A very, very well-regarded bank analyst at RBC, Darko Mihelic, wrote a piece, I want to say 8 months ago, and said, maybe this perception or conventional wisdom around BMO that it's the low credit risk bank is no longer valid because of Bank of the West. But either way, an example here of the challenge of trying to figure out what happens to Bank of Montreal is there's a few things. First of all, what is it premium telling you? I think there's a good chance the premium is telling you that the market believes loan losses that the analysts are estimating are too high. They're probably going to be even lower, and they're pricing that in advance. I don't think the market is saying, we think Bank of Montreal in its current composition deserves a premium valuation over its peers. It might be saying that, we don't know. But that's the whole point of what we're talking about here, is just how hard it is to figure out. So earnings per share growth for this year, according to Bloomberg and the analysts, is 13% and then 18%. So the market's looking for over 30% EPS growth, and it's still trading at a premium on those numbers. So if you suggested that Bank of Montreal's normalized loan losses were $1.5 billion, or somebody were to make that assertion, I don't think that would be, or let's call it $1.8 billion. I don't think the market would say, well, that's crazy. But if you said that they were 2.5, I don't think the market would think that's crazy. So right now, where you sit on Bank of Montreal, it's very, very hard to predict how this valuation and what happens to its stock price, because you have a premium valuation overlaying huge EPS growth, and you have this massive acquisition that's underperforming, and it's not clear whether the market is going to start saying, well, wait a second, this deserves a discount or something along those lines. And Bank of Montreal's ROE was 5% below the average last quarter. Now, that's not a big shock because it was a terrible quarter from a credit perspective, but they've been running at 300 basis points below the average, an ROE discount, or an ROE, a lower ROE relative to the average, for the better part of a year. So it's going to be hard to say. And even before that, in the year before that, it was about 200 basis points different. So is that a profitability profile for a bank to trade at a premium? So right now, there's just a lot of cross currents. So Bank of Montreal, we would say, is an extraordinarily difficult stock to predict. Okay, fine. So that's Bank of Montreal, massive idiosyncratic issue, the resolution of which would be extremely difficult to predict and probably outside the core competency of any of the portfolio managers and bank analysts. So let's move to Bank of Nova Scotia. So my time as a bank analyst, I overlapped the last part of Peter Godsoe, who was a visionary, a brilliant guy. He, I don't want to say famously, but prominently said, he was the architect of Bank of Nova Scotia's strategy of expanding into Latin America. I think he sort of prominently said that, and I wasn't in the room when he said this, but it was communicated or broadly discussed, that they were he bought 4 platforms, and he thought one would be a great success, one would do terrible, and the other 2 would be middling, and that turned out to be very prescient. So for those of you who have followed Bank of Nova Scotia for a long time, you may or may not remember reading in your economic history that Latin America had a series of financial crisis, banking crises, and in the early 90s, they effectively gave their banks to foreigners. Bank of Nova Scotia was near the front of the line. They effectively got a bank for free. That bank is number 5 bank in Mexico, maybe the most value accretive acquisition in the history of Canadian banks. So that turned out to be a massive success. But they also had a bank in Argentina, Banco Quilmes, which failed. It was nationalized. And then the other platforms did fine. So Bank of Nova Scotia, before I started as a bank analyst, we'll call it in the 1990s, traded at a discount. The market was worried about macro risk. They were worried about, or not worried, but it's had a lower ROE. And then Rick Walk takes over for reasons, related to Rick's acumen as well, good management. The bank saw significant improvements in Latin America. Its ROE started to go up. Its EPS growth started to go up. I'm pretty sure that in my 8 years as a bank analyst, Bank of Nova Scotia was the top performing bank over that 8-year period. Did very, very well. Rick gives way to Brian Porter, who becomes the CEO for reasons mostly outside of Brian's control. The Latin America starts to do not as well. Brian, who was very vocal about the previous management team, including in the financial press, started to replace the executives he had inherited. A lot of the portfolio managers and bank analysts didn't really feel comfortable with the management turnover. They got even more uncomfortable with even more management turnover as time went by. And Bank of Nova Scotia made two large wealth management acquisitions, Jarislowsky and Fraser and MD Financial, very, very high multiples. In aggregate, I think it's fair to say they resulted in fairly meaningful ROE dilution. So over Brian's period was a period of significant underperformance. They had their ROE decline, their EPS growth lagged, and then it all came down to when Brian retired. They ran a big search, and the Globe and Mail wrote a blow-by-blow about this. But the fellow running the search was Scott Thompson, and he ended up recommending himself. So you had the market, this becoming a bit of a metaphor for that particular time period and term for Brian, which was somewhat turbulence at the upper end. And so you get Scott Thompson takes over. To his credit, he's reaching out to everybody. He's trying to get advice on what he should do. Fun fact, to the best of my knowledge, he is the first non-banker to run a Canadian bank than Bill Mulholland running BMO in the mid-'80s. And I think it's fair to say that a Canadian bank today is a heck of a lot more complicated than a bank in 1985. That was before the pillars fell. So, okay, so here you are. You got a new CEO, non-banker. He does his first investor day. One of the big takeaways is he wants to increase the amount of capital, the percentage of capital allocated to North America, including Mexico, and wants to reduce the amount of capital that's allocated outside of North America. I think that's a fairly generic comment. I don't know that anybody really was fussed by that. The implementation of that was unknown. And then they buy 15% interest in KeyCorp. So in my 30 plus years career, I think that's the first notable capital allocation a Canadian bank has made that was deliberately, observably, and at the beginning communicated to be passive. The banks have an assimilative culture. They like to buy things. They like to control things. They like to cross-sell. They like to control distribution. So this was right out of left field. The market had a pretty negative view of that. Bank of Nova Scotia, was already trading at a discount. The stock was quite a bit weaker. So I think, and then I'm not going to be able to pronounce this, so I'm going to try not to. Just recently, they entered, and I'm going to read the headline, they entered an agreement to transfer banking operations in Colombia, Costa Rica, and Panama to a bank I can't pronounce in exchange for a 20% interest in this larger Latin American bank. That actually was a pretty smart transaction, or so it would seem right now, at least as it sits today. I think when you look at Bank of Nova Scotia, I think initially it was like, wow, why are you buying something passive? And a very well-regarded bank analyst, Gabrielle Deschênes at National Bank Financial, wrote something along the lines, and I'm paraphrasing, that if the market concludes that Bank of Nova Scotia, with this acquisition of or a stake, 15% stake in KeyCorp, because there's a 5-year standstill, they can't buy any more until 5 years. If the market sees them as saying we want to buy the rest of it in 5 years, so we're going to keep putting capital aside, you're going to get the worst of both worlds, which is lower growth out of Bank of Nova Scotia combined with acquisition risk growing, year after year. It doesn't look like that's the case, but here we sit today. Bank of Nova Scotia trades at 10.4 times this year's earnings and 9.1 times next year. So this is like almost a 1.5 multiple point discount to the average for this year and a 1.5 multiple point discount for next year. And that's with earnings growth of about 23% in total for the next 2 years. And if you look at Bank of Nova Scotia's ROE, it's higher than BMO. So now BMO obviously hasn't done very well in the last quarter, but over the last 4 quarters, they've had a higher ROE than BMO, and yet they traded a much, much lower valuation. So again, back to these idiosyncratic issues and adding complexity and adding challenges. Right now, it's well within the range of possible outcomes that Bank of Nova Scotia gets multiple expansion just because the market just decides, maybe they aren't going to try to buy the rest of KeyCorp. Maybe conventional wisdom on the sell side and the buy side, moderates on its view about acquisition risk. Maybe the market feels more comfortable about the management team, which appears to be off a good start. I would say that the current CEO is off to an excellent start. I also think that the market will come to see that this acquisition of their 15% interest in KeyCorp was actually a very good way to get U.S. exposure without paying control premiums. TD was making acquisitions, large bank acquisitions at over 3 times book. Every bank has been making acquisitions at over 2.5 times book. Here, there was no premium at all. So they're going to get an equity pickup in U.S. exposure. And I think it's fair to say the Key Corp is going to be worth more in 5 years than they paid today. So it would not surprise me if they soften on that view. But having said that, here we are again, this another idiosyncratic issue specific to that bank that's highly material. In this instance, maybe not as material to earnings as, say, Bank of the West is to BMO, but very material to its multiple. So it's also possible that the market just says, you know what, we don't really like the strategy too much. And, listen, we're very comfortable with a 1.5 multiple point discount. But either way, if they pick up a half a multiple point or even 3/4 of a multiple point, that's 8% alpha. And so again, this is adding complexity to trying to assemble your portfolio. What happens to Bank of Nova Scotia? I'm going to skip CIBC and we're going to talk about National Bank. National Bank has been unbelievably successful, extremely well-managed company, very, very big ROE premiums. Louis Vachon was perhaps the most successful Canadian bank CEO in 35, 40 years. Just the sheer duration of his excellence, made a very, very big difference on the bank. But they now trade at 11.7 times. They've completely lost their premium on this year and next year. They traded exactly the average. And yet, their ROE is almost 4% higher than the average. So they've been running at a 300 basis point plus ROE advantage relative to its peers with equal EPS growth for the better part of 5 quarters. So you have a bank with the highest ROE or among the highest ROE with Royal trading at no premium. Now, obviously, when Louis Vachon left, he was so well regarded. It's not surprising that they might see a little bit. But what's happened here with National Bank is they bought Canadian Western Bank. So again, keep talking about 30 years. Over my 30 plus year career, I've never seen 100% premium in any jurisdiction where the bank wasn't in severe distress. So Canadian Western Bank was trading at about 7 times, give or take. The multiples that National Bank paid for Canadian Western Bank were actually perfectly reasonable. The premium was really high because the underlying valuation was very low. So here we are, again, another bank with a very large idiosyncratic issue overlaying its valuation. So a couple things could happen. So if National Bank can close this, which they've closed it, if they can execute this integration, if they can get their accretions, or, Bank Merger 101 beat their accretions, and keep that big ROE difference, then it's hard not to see how they aren't going to get their premium back. It's also possible that the analysts who were or the market was pricing this thing at 7 times for a reason. And maybe, we find out later that there were other credit problems and that, like Bank of the West, they miss all of their forecasts and the bank stays where it is. So again, Canadian bank number 3 with a large idiosyncratic issue that could go either way. That's really the resolution of that issue is more or less outside of anyone's reasonable ability to predict. I think it is fair to say that even though it's out of province, it's still within Canada, and that would increase the probability, in our view, of a successful integration. I think everybody knows all these banks know each other very well. So let's skip RBC and go to TD Bank. It would be a gross understatement to say the events that affected TD Bank weren't anything other than a colossal disappointment to anybody who has owned TD Bank or invested in it. I do think, obviously, what's going on is this anti-money laundering issue and the regulatory overhang are significant. So here, TD Bank, they run into this issue of anti-money laundering. The Wall Street Journal does this huge expose. The results of that expose as it relates to anti-money laundering are extremely damning. So obviously the bank trades off. People are not really worried. I do think the bank analysts as a group are actually quite good. Not one of those people who go back and say, when I was a bank analyst, boy, it was so great and now it's terrible. There's a lot of really good bank analysts, but I think it's absolutely fair to say the sell side got TD totally wrong. The idea that the anti-money laundering charge would be $1 billion, which was conventional wisdom for a while, wasn't our conventional wisdom. I can say that we said that we thought these charges combined with class action lawsuits, which have yet to arise, I still think are likely, but we'll see, would be closer to $5 billion. And so far they're $4.3 billion and going. So we have been directionally very right on TD. So that first correction, we still suggest that people stay away. There's still a ton of regulatory risk. We thought the best example or case study would be Wells Fargo in around 2016, where it ran into a consent order. We actually wrote about it at the time. That note is still on our website, suggesting that Wells Fargo was uninvestable. We still think that, TD Bank has a ton of problems. As it related to the asset cap that ultimately arose, we didn't really have a strong opinion. I don't know that it really mattered. We were much more concerned about capital destruction. We were also concerned with what can the U.S. subsidiary actually make? This is the 10th largest bank in the U.S., give or take. It's a third of the bank earnings. So you did get an asset cap. So now a third of the bank has to shrink by 10%. It did look like TD saw that coming and kind of inflated its balance sheet a little bit, but it's hard to say. So what are the we don't know. Like, the regulators are going to start poking around. Are they going to find, they found problems in Jersey and Florida. They're going to find problems in Philadelphia and Boston, which are very big markets. So they can find problems in Manhattan. There's going to be more scrutiny over this bank for sure. So you have a third of the bank that can't really grow, but and major problems. Like, you are going to be dealing with this issue of this asset cap and consent order for 5 years. This is going to be 5 years. We're going to be talking about this for 5 years. Having said that, and they did avoid capital destruction by selling, at least initially, some Schwab. So they didn't have to issue equity. So that worked out quite well. So they have a new CEO now. I think it's fair to say the sell side seemed to really, really like this new CEO. But let's talk about its valuation. So TD Bank has all of these problems, but it trades like a bank with a ton of problems. It trades at 10.9 times. It's a 1.2 multiple point discount. It's a half multiple point over next year. And the market's looking for very little EPS growth. So unlike BMO, where the market's looking for 30% over the next 2 years, for TD, they're only looking for 7.5. So you're trading at a big discount on much, much lower earnings per share growth, which, we don't know what the U.S. subsidiary can earn. We don't know, are they going to have to close branches because they're going to try to, we don't know how many, what their compliance costs are going to be, what technology changes they need to make. We don't know how distracted management is going to be to try to fix this problem. But, the other day, 2 days ago, was an example of what we've been talking about for the better part of 6 weeks, which is it's extremely hard to predict anything. Out of left field, I think, was they sold all of Schwab. And they just did this massive whack of capital. I was actually a bit surprised the stock didn't react a little bit better. So now they have, whatever, 14 billion, I don't know, it was 20 billion Canadian, I think. And I can't remember the after-tax number, but bottom line, a gigantic amount of capital. So this is a great example of where, the difficulty of assembling your portfolio, and I'm going to talk about it in aggregate, but we'll talk about TD, is, you have this story of they can't grow. Because remember, for since 2004 up until, 4 months ago, the story on TD was that it could grow. It had more retail, it had a great U.S. plant, a very strong U.S. platform, and it was big, and the U.S. economy is better than ours, and all that. And that was all thrown out the window. So now it seems like maybe this story is going to get rewritten again with all of this capital. I think the market, the reason the stock didn't go up more is the market is highly skeptical of their ability to grow through acquisitions in Canada, given the competitiveness of the market and already massive concentration. There's almost nothing worth buying of any materiality for a company the size of TD. But so we'll hold that thought. Let's talk about CIBC, which is a picture of stability and predictability right now. So CIBC trades at, they've lost their discount, most of it anyways. They trade at a little bit of a discount to this year and a little bit of a discount to next year. But most of that has dissipated. But, CIBC deserves a lot of credit. Victor Dodig deserves a lot of credit. I mean, I think we in the market are always focused on activity. We're always thinking, stuff is happening when executives are doing things, because we tend to associate them doing things with something positive. And, Victor Dodig deserves a ton of credit for not making any mistakes. I bought Private Bancorp, but at the end of the day, this bank has done very, very well. And its ROE right now is 100 basis points higher than the average, but you have an average ROE bank right now, basically, trading without any of these idiosyncratic issues and seems to be a picture of stability. So let's move to RBC. I think, competent bank analyst, global bank analyst, could write a 15-page report on why RBC is the best bank in the world. I think it's, you could argue that, if you consider JP Morgan an investment bank, not a commercial bank, I think, RBC, Commonwealth Bank of Australia, maybe the two best banks in the world. If you include JP Morgan, maybe it's the best bank in the world. Bottom line, it's a great bank. Everything about RBC oozes competence. They buy HSBC. Does anybody remember how the integration went? No, because it went perfectly. So this bank has a very, very high ROE. Let me just give you the numbers here. RBC trades at, by the way, a lower ROE than National Bank, but still well above the group. National Bank has the highest ROE by 100 basis points. But so RBC, great platform, great franchise, excellent management. But guess what? It trades like the best bank in the world. It trades at 13 times this year, which is a 1.5 multiple point premium, and a 1.5 multiple point premium to next year. The market's looking for about 15% EPS growth combined over the next 2 years. So here you are today. So before we talk about what the valuations are telling you, you have the reason that we would say it is one of the reasons why it's so hard right now is 4 banks have big issues that are affecting or overhanging their valuation or influencing their valuation. And as that issue evolves, predicting how it affects the overall valuation and what it does to the overall earnings is extremely difficult. And then combined with that, the multiples have very, very wide dispersion, right? The lowest multiple bank here is 10.4. The highest multiple bank is 13. So, you have a pretty big spread between the highest and the lowest. And so if, right now, if you said that RBC would have the best operating performance, but would underperform this year, that would seem perfectly reasonable. If the market decides in 6 months that RBC's premium should be a half multiple point premium or 1 multiple point premium, let's say a half multiple premium, it loses 5% of alpha. So multiple compression would cost it 5% relative to its peers. So right now, normally, if you look back historically, if banks rise, say their earnings per share growth is up 10% a year for 10 years, generally speaking, the stocks have often correlated very, very closely with that. They would be up 10% a year. And then the top performing bank would have had multiple expansion. The bottom performing bank would have multiple compression. But the primary driver was EPS growth. Now, for the next probably 12 to 18 months, multiple changes and changes in relative valuation are going to be much, much bigger impact on share prices and relative performance than they are traditionally, and they're very, very hard to predict. So you want to go to the next point, Pat?
Yeah, so why don't we move on to the topic of expansion and how important a theme that is for investors, because there's been a lot of activity over the past few decades. So I think this is
actually, you know what? I forgot to mention one point, Pat. So hold that thought. Sorry.
Yeah.
So I should have. I apologize. I jumped too quickly. The top down of the Canadian banking sector is actually relatively positive. You are on the cusp of a credit recovery. What you've seen followed the history of credit cycles to a T over the last 50 years. Bank stocks rallied 2 quarters in advance of loan losses peaking. You are almost certainly Q4 of this past year, i.e. last quarter. You saw the peak in loan losses. You are on the cusp of a credit recovery. History would show the analysts typically underestimate the decline, and we have shown that quantitatively in our past work, which would suggest to you that earnings estimates are probably too low, generally speaking. So that would be the plus side. The other side is that GDP growth in Canada is not very good. In fact, it's quite mediocre. Fiscal policy, which we'll talk about in a moment, has been terrible. So it's very hard to get very excited about a national banking sector when GDP growth is 1. And so you have credit recovery as a favorable backdrop, possibly falling interest rates, which could help capital markets, but you also have mediocre GDP growth. So the backdrop, and you have the banks have tons of capital and reserves. So at the end of the day, it's just a giant mess. Go ahead, Pat. Sorry.
So why don't we move on to the topic of expansion? And
yeah, so I think it's quite interesting. For a long period of time, TD Bank was a forceful advocate, particularly under Ed Clark, with the following idea, which is retail is high multiple, is a high multiple point business. Capital markets is a low multiple business, and therefore you want more retail, less capital markets. That's a business mix that deserves a premium. And in order to expand or build, retail, they did it outside of Canada, and they did massive large platform, one strategy. I know they had Ameritrade, but let's leave that aside. But it was completely dominated from a capital allocation perspective on one platform. On the other side, you had other banks like RBC and National who were very comfortable having capital markets in their business mix and very comfortable having capital markets even outside of Canada in the case of RBC. So RBC and National have relatively diversified foreign platforms. Their foreign strategy is a couple of buckets. It's not one giant bet. And so I think what we found with the benefit of hindsight is that a, a foreign expansion strategy or even a business mix that has a healthy dose of capital markets, generally speaking, is very supportive of your ROE because big capital markets quarters produce more capital and it gets deployed in other areas. And you don't take that one singular bet. So I do think, Gord Nixon, Louis Vachon look very smart with the benefit of hindsight. I don't know that TD looks as strong given this massive bet that ultimately ended up, having a ton of regulatory risk, and not just the regulatory risk that we've seen with this anti-money laundering charges, but also people may or may not remember that the largest acquisition and the last acquisition that TD Bank made of any consequence was Commerce Bancorp, where they paid $8.5 billion, and that deal closed on the eve of the financial crisis. So TD ended up with just a mountain of regulatory risk. Capital ended up doubling. There's no way they made any of their financial forecasts because they did not forecast that capital would double and a regulatory environment would change dramatically. And obviously, they missed this anti-money laundering. Bottom line is, right now, the more diversified your foreign expansion strategy is, I would say that strategy has been a more favorable one and probably deserves a higher multiple. I think this is relevant because if you've seen BMO's essentially doubled down, more than doubled down, by this massive platform and acquisition in the United States. So I would keep an eye on that. But I do think when you're thinking about who should trade at a premium, who should trade at maybe not quite a premium or a different multiple, business mix, foreign expansion strategy, and National Bank might be the only bank to say that their foreign expansion strategy was ROE accretive.
Why don't we shift gears? A common question we often get from investors is, where are the Canadian banks going to from here? There seems to be, maybe the Canadian economy is just sort of, mediocre right now. What types of catalysts could we possibly see, and is credit one of them? And can you go through some of the loan loss accounting background?
Yeah, I don't know if you want to change the slide. Yeah, so as I mentioned, I think it's almost certainly true that loan losses have peaked and that they will start to fall. That is the big driver. That is one of the biggest components of EPS growth forecasts right now, which are pretty healthy. In the case of BMO, they're a gigantic. And all of that is a positive. And as I just mentioned, the analysts typically are conservative in forecasting loan loss declines historically. And because that happens so consistently, I think it's reasonable to assume at least the idea that valuations are maybe a third of a multiple point lower than they might otherwise be because the analysts have been more conservative. Although in the case of BMO, I think the market is saying we think loan losses are going even lower than the sell side thinks. But one thing that's different, the new loan loss accounting started in 2018. And I don't want to go, I've gone through the details in other forums and my previous iteration of this presentation was heavy on loan loss accounting and why it matters. But at the end of the day, Cole's notes, if you will, is the old loan loss accounting. A loan had to go into default and not be current in interest and principal. The bank would estimate its losses. They would book a provisions for credit losses and expense, which reduced earnings. And on the balance sheet, they would book an allowance for credit losses, or what the Americans call a reserve. In 2018, they added another bucket, which is the regulators essentially said, okay, well, maybe you're booking loan losses and estimated losses against loans that have defaulted or become impaired, but we think the rest of the portfolio has losses even if they haven't emerged yet. And we want you, and I'm simplifying here, we want you to book most of the life, or at least 1 year's worth of losses for most of it. We want that booked today. So this allowance on performing loans, which didn't exist when I was a bank analyst, for example, is now $23 billion. So just to emphasize here, the banks have set aside against loans that are still perfectly fine, and we have a credit recovery coming, of $23 billion. They're still fine, current in interest and principal. So what you saw in 2021 was this reserve, this performing allowance got built, and then it got released. And although this is a non-cash flow item and it would seem to be only accounting and nobody would care, that's only half true, because in order to build that allowance, you have to take money out of capital and put it over into this allowance. If that allowance gets released, it goes back into capital. And it also is a signaling mechanism to the market, which is the management essentially saying our macroeconomic forecasts are better. And so what you saw in 2021 was a tremendous rally, not only because loan loss releases started to occur and they became meaningful, but what it said about it as well. So you had this virtuous circle, you had loan losses falling, you had performing allowance releases, which was telling the market that the banks thought the macro environment was better, but that also resulted in higher capital, and everybody liked that, and the banks had a tremendous year. It's possible that we're entering a period maybe where you don't get the same reserve releases, but you have the quantum that you got in 2021, but that you get them in 2025, starting this year. And if you start to get reserve releases, or even if the build of this allowance goes to zero or modestly negative, even that would remove a headwind if it's not going to give you a tailwind. But there is a good chance that this loan loss accounting could be a bit of a sleeper in terms of contributing to higher EPS growth, higher capital, and therefore better valuations.
I'll note we have written about the new loan loss accounting on our website, so we have quite a bit of information in our insights section if people want to read further on this topic. Why don't we shift gears into the current political climate, which is fairly uncertain right now. Do you think it's possible this could bring some opportunity going forward?
Yeah, so let's leave aside the tariffs and the president, or even the name of the president. Let's just set that aside for a moment, or compartmentalize. I think it's fair to say it's objectively true that fiscal policy in the last 10 years has not been and had a pro-growth emphasis, whether it's taxation, whether it's the treatment of the energy sector, the resource sector, take your pick. And we have the Canadian economy has felt the effects of that fiscal policy, which is not emphasizing growth and productivity and capital investment and innovation. And so obviously we all know GDP per capita has barely moved for 7 years, and GDP growth is quite mediocre. That's been our backdrop. That was the one I referenced. But whoever becomes the next prime minister, whoever becomes the next finance minister, if there is a significant emphasis on growth and taxation reform, for whatever reason, leaving aside some of the other competing policy objectives, anything that spurs investment in the energy sector, which is obviously extremely important, could be very good for GDP growth, because Canada has been, obviously lagging significantly in capital investment, and that has weighed heavily on GDP growth. We also have rising unemployment, by the way. So if you can get a significant change in fiscal policy, I don't think it's unreasonable to assume the sector could see some multiple expansion. I don't think it's unreasonable to assume that GDP growth would respond. It's quite possible that there's some pent-up investment that could drive higher GDP growth for a period of 2 years, for example. But the bottom line is the fiscal policy that we currently are experiencing probably could not be worse. It's probably the worst fiscal policy since the early 80s. They printed a $62 billion deficit. It's just not very good right now. And so GDP growth is a very big driver of both sentiment and multiples, and sorry, not just sentiment, revenue growth, excuse me. And so if you can get GDP growth even going to 2.5, that could be very, very bullish for the sector. So I think we are coming to a head. It's possible we have more of the same fiscal policy, which I think the market is broadly assuming. But it's also possible that we get some real political reform, which, if it had a big impact on GDP growth, which it could, that would be great for the sector.
Okay, so why don't we shift into just some recommendations for what Canadian investors should be considering going forward in terms of ETF exposure and
ordinarily we would talk about own your 3 Canadian banks, and pick your 3. We have some other products that we think could help you supplement the exposure. Our Australian bank ETF, for example, our global financials, and we have US midcaps. But right now, I don't think there's ever been a time where low cost equal weight exposure was more appropriate. I mean, HEB, the Hamilton Canadian Bank Equal Weight Index ETF, or HFN, the Hamilton Canadian Financials Index ETF. Like right now, you don't know what's going to happen to the picking the top performing bank right now is extraordinarily difficult. Picking the performance of four of the Canadian banks is extremely difficult. For example, TD did, this big sale of Schwab. Like, who knows? TD could be a huge outperformer over the next 12 months, or it could be mired in regulatory risk. So do you want to buy TD? Listen, it could be great. It might not be great. BMO could be great. It might not be great. Right now, owning the big six, HEB, for example, which has no fee for the next year, roughly, or 11 and a half months, give or take, is a great solution right now because you get exposed. There's going to be winners, there's going to be losers, there's going to be surprises, and it's fundamentally extremely difficult right now to assemble your portfolio. HFN, again, same idea, although you would add in the life insurers primarily. Again, in terms of figuring out do the life cos outperform the banks, and it's going to be an issue. Also, you don't really know what this tariff stuff is going to happen, and I know everybody is very, very focused on this issue. The idea of tariffs and threats of tariffs was a common theme in his first term. We'll see what happens here, but the bottom line is, right now, it's very, very difficult. If you're bullish the sector and you think, listen, credit is going to be better than expected, we think that GDP growth will move higher. We think that EPS growth is going to be very, very solid. We think this tariff issue is going to dissipate. Then, HCAL, the Hamilton Enhanced Canadian Bank ETF, which has about, I don't know, not quite 600 million of AUM, just a modest amount of leverage gives you a higher yield. And if you got a 5-year time horizon or 3-year time horizon, that incremental return, listen, as long as you think the banks are going to go up, HCAL and HFIN is a modestly levered version of Canadian financials. They're gonna work to your benefit. We like the 25% leverage because we think it's kind of the Goldilocks amount. It's big enough to matter, but it's not so big that it fundamentally alters the risk profile of your portfolio. So we think all of these products are in very good shape. But right now, if you're trying to pick your favorite 3 Canadian banks, good luck with that. It's very, very difficult, even for professionals right now. We would argue that for the next 12 to 24 months, a simple, plain vanilla, zero fee Canadian bank ETF is the place to go, is the place to be for your exposure.
Rob, why don't we quickly, and we'll conclude with just a few global ideas, just for investors that might want, maybe just talk about why diversification makes sense as well.
Yeah, I mean, so for many, many years, we've always said, listen, own your 3 Canadian banks, pick your 3. We generally said own Royal and National, and you decide on your third, and pick those 3. But we have other solutions which could really help you, and they could be sleeves that could round out your Canadian bank exposure. The Hamilton Australian Equal Weight Bank Index ETF, ticker HBA, is a perfect example. It's Canadian hedged. Think of Australia as a competently governed version of Canada with equally good banks. So over the last 25 years, the return volatility profile of Australian banks and Canadian banks has been nearly identical, but they're not overly correlated. They are correlated because they're banks and they're in developed economies, but they're not overly correlated. Bottom line is, you pick your 3. In the old days, before we suggested just getting 6 vanilla, equal weight exposure, because that's simpler right now, and that way you diversify away all of this event risk. Here we would say somewhere in your portfolio should be HBA. It's fund graded A+. It's been outperforming the Canadian banks since we launched it. It's done everything we said it would do. It's an excellent country, quite a bit wealthier than Canada, 20+% wealthier GDP per capita than us. As I said, it's currency hedged. GDP growth in Australia is almost always 50 to 100 basis points higher than Canada. And fiscal policy there is quite sustainable. So the macro risk of Australia is lower and different, right? If you own HBA, which a lot of our clients do because it's a $150 million fund, you don't care about tariffs right now. This is a perfect example of why something like HBA, so ultra blue chip country, ultra blue chip sector, and it's got a pretty good yield, and it is hedged to CAD, so there's no real credit risk. I will point out that although this fund is a pretty good size, the trading volumes for some of the people on the phone, if you go look, might not seem high enough for you. Remember, there's a market maker people who buy this fund never sell it, so it doesn't trade as much as you might think, but a market maker will create on-demand liquidity for you in and out. So you never do a market order, do a limit order at the ask. You can literally do almost whichever you want. You could put in $25 million. The market maker will fill you. This is a mega cap sector. The underlying liquidity is extremely high. So at the end of the day, we think this is a great product, and everything we've talked about it, I think, has stood the test of time.
Let's move on to our global financials ETF, HFG, Rob.
Yeah, so this is think of a fund of global leaders. This has also done extremely well. Also, fund grade, rated A plus. Again, a sleeve. We're not suggesting that if you own $100 of financials, that $100 should be HFG, although that wouldn't bother us. But 10% in HFG. It's got a 20% annualized return since inception. It's actively managed. We can move around and to identify what we think are the most attractive themes and geographies. We can also find the most attractive reasons within certain geographies. And this again, instead of owning, all Canadian banks, have a sleeve for this. As you can see, it's done extremely well. Even with this massive rally in the Canadian banks and it not having a ton of Canadian banks, it's still outperformed. So this has done great. Again, for advisors and investors who are trying to manage volatility, this fund has done extremely well, and it is loaded with blue chips.
And then finally, let's move on to a US idea here.
Sure, I beg people to buy this fund. I own it. It won a Lipper Award, the Hamilton US Mid Cap Financials ETF, ticker HUM. I can't believe this fund isn't $400 million. It has outperformed literally every period, every other US financials bank, US, either whether they're trading the US or trading Canada. It's done extremely well. Why has it done so well? The main reason is it's a great category. It's just a great category. You can't do it on your own. We do it. The mid caps have outperformed the large caps for a very, very long period of time. Over time, they've been much lower risk. They're simpler companies. They benefit from ongoing M&A, which for the U.S. mid cap financials is a secular theme, not a cyclical theme. You can customize your portfolio by geography, which is to say, because this category is almost as big as I think is as big as the Canadian equity markets, you can emphasize high growth regions. Because keep in mind, the US economy is not as homogeneous as many people believe. It's 5 regional economies. In this fund, you can load up or you can emphasize or overweight the Southeast and the Southwest. You can get lots of Tennessee. You can get Georgia, Florida, Texas, Arizona, the Carolinas, and you can avoid Illinois, which is basically a broken state right now, losing or hemorrhaging people, probably going to go bankrupt in the next 10 years. You can avoid New York State, also a terrible state for banking, losing people, mediocre GDP. Maybe you can avoid Jersey and Connecticut. Maybe you're okay with Pennsylvania. As a general rule. So you could engineer a portfolio that has GDP growth that's 50 to 100% higher than the national average. So this fund has benefited from great stock selection. It's not all banks. It's 50% banks, roughly. It's won a Lipper Award. It's got great performance and consistent performance, including during the turbulence of the mid caps with CIVB, where it had a lower drawdown than the large cap banks, even though it was in the area that was having the most problems. It's still massively outperformed, or significantly outperformed, I should say. So this is a really, really good fund. For those of you on the call, if you have $100 of US financials, $30, $20 should be in this fund, given how successful it's been and given how high quality the category is. And so if you own like B of A, JP Morgan, Citi, and Goldman and BlackRock, taking 20% each out of that and buying something like this has definitely stood the test of time. And interestingly enough, even though it's done very, very well from an operating performance, the large caps have outperformed the mid caps in the last, I want to say, year and a half. So the valuation spread between large caps and mid caps is now highly favorable. So even though this fund has performed extremely well, it's still, for those of you who are interested in value in particular, is very appealing right now. It's actually extremely timely fund.
And do you want to just conclude with our champions ETFs, Rob?
Yeah, I mean, these are great we're very excited to be offering, you know, uh, the Hamilton Champions Canadian Dividend Index ETF, broad-based ETFs with a very low fee. In this case, for the CMVP and SMVP, which is Canada and US respectively, 0% management fee for about a year and a half, or sorry, 11 and a half months, excuse me. And they're enhanced versions. These are excellent products. They are dividend growers, as you pointed out at the beginning of your of your remarks. The sector mix is very much focused on those sectors that have strong dividend growth profiles and have for a period of time. And that does, as a result, it does underweight tech, which is obviously a great sector. We have a tech covered call ETF, which is quite large. It's a great sector, but there's a lot of concentration risk. And this is a good way to, is a great sleeve for your portfolio. And it should, we hope over time, result in lower volatility and more consistent returns.
Thank you, Rob, and thank you everyone for joining us today. We will be sending a replay out in the coming days as well if you wanted to tune in or if you didn't catch it all. But we appreciate your time and we appreciate your support. Have a good evening, everybody.
Yeah, thank you for your time and attention.